Germany is Europe's largest economy and it's been struggling for years. Now, twice a year, the government's Council of Economic Advisers publishes its report on how things are going. Lars Holte is with Deutsche Welle and joins me from Berlin on the story. Lars, what did you learn from the latest report this week?
Thanks for having me. So when you're looking at a report on the economy, usually the numbers are what's making headlines. In this case, however, I find more significant what words the Council uses to describe the economic situation in Germany and the government's response. And what they're saying is not pretty. The economic expectations are, quote, too optimistic, investment is too low, tax reform and EU policy is too half-hearted. So all around, that's pretty bad. Now, if we do want to talk about some numbers for 2026, next year, the Council expects growth of only 0.9%. And here's that too optimistic, as the government recently put that number at a much stronger 1.3%. Anyway, it gets even worse. Of those 0.9%, the Council says that a third of the growth will be bought by government spending. Another third is due to calendar effects, meaning that next year more holidays will fall on weekends, leaving the economy with a few more workdays. Now, outside these effects, we're looking at 0.3% of real growth, and that is very, very little.
Okay, Lars, the government had high hopes to strengthen the economy much faster. What happened there?
Indeed, the government had some good plans, even some audacious plans, right after the elections early this year. And indeed, even before the new government was officially in place, they agreed on 2 spending packages for which they even lifted the country's long ironclad debt brake. Berlin decided to invest 500 billion euros in defense and another 500 billion in strengthening the country's infrastructure. That was a bold move, and it came with all the hope for jobs and for improvement everywhere. But the Economic Advisory Council now says that the funds are not being spent fast enough and that they're not being spent the right way. They say that instead of really investing money in new projects, in building things, a large chunk has simply flowed towards the social system, into higher retirement funds for mothers, into higher tax rebates for commuters. All per se may be valuable or at least worth discussing, but this kind of spending does not support the economic growth of a country. And thus, the experts are telling the government that they're doing a pretty bad job, and they're giving the Merz government a C- for their handling of the economy.
Okay. And how are the experts viewing all this? Are they optimistic that the government can adjust its course and better strengthen the economy?
If they are optimistic, they certainly didn't let us hear it. In fact, the experts are seeing so many systemic challenges that it's hard to see light at the end of the tunnel. They're asking for fundamental reform of the tax system and much lower corporate taxes. They're asking for fundamental energy reform instead of just subsidies for energy-intense businesses to alleviate their cost pressure. But we do know, of course, that fundamental reforms are not happening quickly. And then there's also the European Union. The Council says that Brussels is failing to organize the 27-member bloc as a common market in an efficient way. There's too many trade barriers still. There's high cost. There's lots of bureaucracy. So while they're saying that the government in Berlin has to get its act together and do better, they're also warning that it might still not be enough without others acting too.